So, ladies and gentlemen, thank you very much. I guess we've had some very interesting discussions earlier in the day, or earlier in the morning, and what we're going to try to do is drill down into a little bit more detail, and between myself and my co-presenter Alex, really talk about the business models within PPP and how they can apply. But what I would like to do is start with some preliminary questions, and I guess it goes back to the earlier panel. There's questions that need to be asked as you're getting into a concession. That why are airports attractive investments, and why is the government considering a privatization, and what does it look like in a secondary market as well as those airports transact throughout the life of a concession. Talking a bit about the pricing comparables to make sure that we understand what the aspects are between the various regions, but also the traffic growth and resilience that was talked about earlier, and ultimately the operating cost dynamics. So one of the reasons that airports are attractive is the low competition risk, and that also has to be balanced, as we talked about earlier, with the monopoly aspect of abusing that low competitive environment. But also, it's a very steady, predictable, and diversified revenue stream, unlike a lot of other concessions, which may only be, whether it's a water concession or a rail concession, other things. There are very limited numbers of opportunities to grow revenue and traffic, but in the case of airports, it's a much more diversified growth of multiple revenue streams. But also, as I alluded to earlier, this is becoming a very mature secondary market, and we have to consider those secondary transactions. But looking at what's been happening in the industry over the last number of years, you can see the multiples have been fairly consistent of around 12 times EBITDA, but there's been a few exceptions, and one that we see is the two Brazilian examples, Sao Paulo and Viracopos. Consider that a bit of a feeding frenzy, and that was well over 30 times EBITDA. That raised a lot of eyebrows back in the day, and we're now seeing that that wasn't resilient, that when the market softened in Brazil due to the economic downturn and the scandal that triggered it, those concessions are having some trouble, in particular Viracopos. But also you see a few trophy assets like London City, and it's now transacted a couple of times and at very high multiples, but has been much more resilient despite the fact of a very high multiple. Fairly busy chart on the bottom, but you can see again many more data points to kind of back up the more general look that we see on the top of this slide. More detail and slightly more current transactions. You can see that trend line though. The long-term PAX trend and the overall average transaction multiple seem to be tracking, but on a more sort of moderate pace than what we saw in the earlier slides. We also took a look at a number of the companies with their competitive analysis companies, both airport operators and investors, to see what those multiples looked like. And you can see it ranges from a low of 8.25 or 8.26 for Fraport up to 36 times for Copenhagen. So again, a great variation in what the multiples look like, but there's a lot of different issues behind each one of these multiples that would take an entire presentation just to explain the detail behind them. The important thing is, as we talked about in the earlier presentations, what are the drivers behind the privatizations and the private sector investment? Private investors need to make money, but the government also needs to be ensuring that it gets its share, but that the operators and the airlines are also operating within a sustainable framework. So this is a similar chart to what you saw earlier, but overlaying a number of the shocks that we've seen over the last 20 years. And of course, it starts with the oil crisis. It goes into a number of the regional wars, then into the Asia crisis, into SARS. Let's hope we're not heading into a second SARS soon. But what it does show is that there's always a recovery, and the sharp decrease is always replaced by a very sharp recovery over the period of time. And as you can see from this chart, that represents about 7.1 trillion RPKs. This is another chart that we like to kind of contrast the growth and the stability of what is the strongest player in the market, and that was alluded to again earlier. The U.S. market has been and continues to be the strongest market, but we do see, as predicted by the IATA numbers, that China will soon, as we get off the edge of this chart, will start to overtake the U.S. as the largest aviation market. We often forget that on the left-hand side there was another strong player that actually dropped off and will likely reemerge on the right-hand side of this chart a few years down the road. But the former Soviet Union was, back in the 90s, one of the dominant players in the industry in terms of growth, and obviously that has changed for many reasons. This is just another way of looking at the earlier numbers, but I think the really important thing to keep looking at here is that the fastest growing airports are all in Asia. You've got Thailand, China, Vietnam, Indonesia, and it all has to do with the growth in those areas and the delivery of new aircraft, particularly into Southeast Asia. The other thing we found interesting in looking at data and the trends is this is somewhat against the intuitiveness of bigger is better, but actually around 5 million passengers is where you find a sweet spot for basically contrasting total passengers to operating costs. So a lot of the bigger operators are always looking for 10, 15, 20 million passenger airports to go after, but on a pure profitability basis, a smaller single runway airport tends to be more attractive because it requires less capital and it's more efficient. As you get into second terminal, second runway, you start getting into higher operating costs. You have to invest in a people mover. You have to develop dual operations in 2 terminals. So, a single terminal, single runway airport actually, as a percentage, tends to be more profitable. So, quickly looking into granting of rights, the competitive interest in private sector penetration, really talking about the framework of the deal, that's going to lead you to understanding what's the right model. And I'll touch a little bit at the end of my presentation on those various models, but then Alex will go into a deeper sort of exploration of those various models. So, granting of rights, it sounds a bit benign or somewhat boring to talk about granting of rights, but it's absolutely indispensable. If you don't have a grant, you don't have a project. But the nature of that grant and the way it's structured is absolutely critical. And again, IFC is very involved in helping governments get to the right structure before they go to market. So ensuring that all of these aspects, in particular the exclusivity, is well defined. What's the object of the government? Is it just to make money? Is it to improve the level of service? Is it to improve the capacity? Is it a combination of those things? But that gets built into the fabric of the concession. The length of term is also critical. Of course, the investors want to have it for as long as they possibly can, and the government would like to reduce it, but finding the equilibrium between those 2 factors is important. But what's the form of the agreement? And Jacques talked a little bit earlier about, is it a management agreement? Is it concession? Is it a lease? Is it a freehold? Those are all very important, valid questions to ask very, very early on as you're structuring. And then, how is the actual fee structure set up? Is it a big upfront key payment? Is there a fairly steady and static concession fee over the period of time? Or is it based on some more novel approaches? And we've seen a lot of different ways in which it can be done, but you don't come and start with a framework and impose it on an airport. You figure out by studying it, and again, this is what Alex and I were talking about before the session, was what works for that airport, and making sure that you actually do that deep analysis before you actually put it out to market. And what is the regulatory environment? And I think we can look at places like India where they struggled. They had a number of different attempts to do concessions. Some of them were successful and some of them became a bit difficult and were taken off the market because they weren't ideally structured to bring to market. So getting the economic regulation right, and we've talked about that in Saudi Arabia and other environments as well, that's a key issue. The other reality that we all have to be aware of is there's a lot of competing interests within a concession, within the development of a concession framework, and often within a consortium. You can often have investors, financiers, operators, and contractors that are all inside the same room, and particularly when you mix operators, contractors, and investors, that can create a conflict of interest within a consortium if it's not properly structured. So the structure of the concession is important, but of the concession company as well. If the motivation is to build quickly and take profit and run, and your biggest contract or your biggest investor is a contractor, you may have to watch very closely how you structure your concession. A slightly different version of what Halid showed a little bit earlier, but we wanted to show, it's quite stark when you look at private sector participation by the percentage of passengers. A very mature market in Europe, and not only are there a lot of primary concessions out there and pure privatizations of freehold, but there's a lot of secondary activity because those concessions are getting older now and are starting to see a recycling of capital. Down in the Latin American region, you're seeing a very mature market, and there's only one or two major capitals left in Latin America that are not concessioned, so a very mature and comfortable familiarity with privatization. Starting to see more in Asia, and keep in mind these numbers are a little bit distorted by the fact that some very large hubs are included in those numbers, and when you do it by passenger, it's a big number, but by actual individual airports, it becomes a bit smaller. Seeing more and more activity in this region as well, a little bit more in Asia, but somewhat embarrassingly for somebody that hails from Vancouver, the North American market, private sector investment in airports is 1%. Due largely to the fact that those airports are operated by local municipal entities that have found more value in the political value of those airports rather than the capital investment. And that is also why, as was said earlier, they tend to be more profitable because these airports are not well invested in, and the capital costs are very low because they're behind the curve on investment. So overall, 43%, if you average all those numbers, but still a long way to go. The next focus we'd like to talk about is on investment drivers, the critical trends, a quick overview of the operating models and financing models. Don't think we're going to have time for the case studies, but happy later on if anybody wants to talk specifically about case studies. We have a number of them that are in the presentation and will be available to you later if you want to get a copy of the presentation. So some of the information provided by ACI has been helpful. It shows a lot of the same information, but in different and more in-depth ways. But medium-term investments that are needed are starting to approach the area of $10.7 billion by 2022. We know that privatization is becoming increasingly popular, but it's still Europe that remains the most attractive or the most comfortable with the model, but it continues to grow and become more pervasive throughout the world. The real key is getting a regulation and a regulatory model that people are comfortable with to be able to invest and know that they've got the security when they go in to invest in those airports. Some more information as provided by ACI that gives you a bit of a perspective, and you can see the charts on the right-hand side talking about private investment in airports and where that's moved over the last 10, 15 years. But most importantly, it is becoming an issue of more common format, but size does matter. And as we looked at earlier, 5 million is kind of the sweet spot, but as you get into bigger and bigger airports, activating more capital is important, and a lot of the big investors don't want to spend any time on a $50 million project because it takes as much work to do due diligence on a $50 million project as it does a $500 million project. So these are some of the challenges. There are profitability in small airports, but they're just as much work as a big airport. The other approach may be to start bundling smaller airports into a platform or into an investment vehicle. 5, 10 million passenger airports could be just as interesting and maybe more profitable and resilient as a single 50 million passenger airport that's going to go through individual cycles, whereas a bundle of airports can be more resilient. So very quickly, looking at the ownership models from a spectrum, we can see that pure government agencies, very common in the US and Canada. What we're seeing more so in Japan is they're moving from a purely government model into more diversified ways of doing it. But we're seeing across this entire spectrum, airports across the world are seeing more and more private sector involvement, and ultimately it really comes down to what works best And sometimes you'll see a movement of airports across this spectrum as they mature and as they develop. One of the challenges we had was placing Dubai on this spectrum, because in some ways it's a government-owned company, but it's also a bit of a joint venture. So not everything fits perfectly into a slot on the diagram, but it gives you an idea of the diversity in the spectrum. So the final thing to leave you with on this, every airport has its own unique DNA. There's not a single answer to what makes the most sense for each individual airport or group of airports, but you need to do your homework, and that's where IFC and others will help in terms of structuring the right deal to make it attractive to the private sector, but also making it attractive and a good value proposition for the grantor or the government. But it's all about level of control and transfer of risk. What is the comfort of that particular government in transferring ownership and accountability? So in the interest of time, again, there's a lot of further detail that really drills down into this, but I'd like to give Alex a bit of time to drill down into those models. But as you can see, stakeholder input and political considerations are a huge consideration when structuring. And ultimately, what are the background behind these various drivers? You know, in BA, it was about political philosophy. The BA breakup was more about a monopoly that needed to be restructured, but it goes through the spectrum of different reasons why airports are structured or restructured, and addressing both the macroeconomic, the financial, and the management side of it. So what are the grantor's key objectives? That's a key question. And what are the potential for the investors, and what makes sense for both parties? And finally, again, very similar to a slide that was put up by Khaled, it's the spectrum between government-owned through onto a privately owned concession. So we all deal with acronyms every day. It's a bit of a minefield, and frankly, it doesn't really matter the detail behind each one of them, but ultimately that they make sense for the concession and making sense for the overall structure of the deal. So that brings us to the end. As I said, we've got a number of case studies, which as we have opportunity, if you'd like to approach me afterwards, happy to talk a little bit more about them. But Heathrow is an example, Malaysia Airports, and the group of Mexican airports in Latin America. So that wraps up my very brief discussion. I'd like to hand it over to Alex and our Master of Ceremonies. Thank you very much.
Thank you, Mr. Curtis. First, let me introduce Mr. Alexandre Leigh. He's the Airport Investment Specialist, IFC World Bank. Mr. Alexandre, short for Alex, has over 15 years of international banking experience in both investment and advisory positions with HSBC, Macquarie Capital, and at IFC since 2009, where he covers the MENA region as well as airport sector coverage globally. His experience is multi-sectoral and has included airports, maritime transport, engineering, consumer goods, and real estate across Europe, Latin America, Middle East, and Asia. He's a business school graduate from HEC Paris and holds an economics degree from McGill University in Montreal. Once again, Mr. Alexandre Leigh. Round of applause, please.
Checking this out. So good morning, ladies and gentlemen. As Curtis mentioned, we're going to try and not overlap too much in terms of what he introduced and also the previous presentations. Quick words of introduction. So IFC is advisor to government clients. We operate globally. My role is essentially to support all our teams across all the regions we operate in terms of developing PPP type projects in airport sector. So moving on to PPPs, I think One point I'd like to reinforce, and hopefully it comes out of this presentation, is that there's no one single PPP model. And also to clarify, for me, PPPs, I'm going to use PPPs and privatizations kind of interchangeably. I know people have different understandings what a PPP is. They think privatization is separate from PPPs. We get wedded to this acronym in terms of BOTs, DBFOMs, ONMs. I think we need to move a bit beyond this and really think what is a solution? What is the government trying to achieve in terms of bringing in the private sector? And even, is there space for a private sector in this particular project? So rather than applying template approaches, which I think has been the issue in some countries, we need to really think through what the needs are and which model is applicable. And beyond the model, I think, and I had an interesting discussion with one of our government clients recently, and they were focusing very much on the BOT model without quite understanding what the BOT model was and why it was applicable. And after 10 minutes discussion, we realized that the model was not applicable at all to what they were thinking of, but someone had told them about BOTs, and they were kind of fixated on that. So I think terminology is useful, but we need to move beyond terminology and really think about solutions rather than acronyms. So moving on, just a quick presentation in terms of where we stand in terms of PPPs, PSPs globally. As was mentioned previously, I think there's a very large range of private sector participation from region to region. You see Europe, which is obviously leading the pack, which has had a head start from the 70s and 80s in terms of leading through full privatization models. And then you have a North American model. Maybe I need to update it with a 1% Curtis you mentioned. So maybe 99 and 1. That's linked to various issues. I think the models that we see across each of the regions vary considerably. So Western Europe, we've had mainly privatizations. Latin America, we've had kind of long-term concession type models. In other parts of the world, in emerging markets, which is where IFC's focus is, we've had concession type models, big focus on brownfield or greenfield investments given the need for new infrastructure. So why is that? Why do we have such a range of models or approaches? I think there's a mix of reasons. Not all of them are rational, I would say. Some are linked to legal reasons, some are linked to cultural, historical reasons. So in some cases, perhaps they were not fully adapted to the objectives of the government at hand, but they were driven by a multitude of reasons. I think another point to mention here, so we've got 43% of air traffic which is handled by the private sector. If you convert that into what it means in terms of airports, we're talking around 14% of airports globally are managed by the private sector. Now that number, both for 14% and 43%, have risen quite a bit over the last decade. It will continue to increase. I think the focus now will be less on kind of a capital city anchor airports. I think many governments have realized, perhaps late in some cases, that they have many other airports in their ecosystem. They may have regional airports, secondary city airports, and focusing solely on their main capital airports and not dealing with the future investment needs, operational needs of their secondary airports is an issue. You see an example now in India where they're pushing 70 to 100 regional airports in terms of privatizing those, probably through a clustering type model, so packaging them in entities which make sense for the private sector to participate. And the reason they're doing that is, many of these airports are very small airports. They're 10, 50,000 passenger airports, but they're in areas where population growth is anticipated to increase tremendously over the next 10, 20 years. So they want to build around these future catchment areas new connectivity points for the country. So in terms of the models we've seen globally, I mentioned there was a range of approaches. So North America, mainly publicly operated through municipalities, and Curtis went into the rationale around why that was the case. You've had some terminal PPP-type concession approaches, or O&Ms, that have been attempted and are being attempted as well. You've got the Canadian model, which is kind of a non-profit approach, which I'll come to later. In terms of Latin America, Caribbean, these are kind of long-term concession models. You've got the Brazilian example, you've got the Mexican model in terms of regional clusters that was developed. You've got Colombia, you've got the Argentinian model with a whole airport ecosystem. Airports in Jamaica, including some of which we've worked on as well. In terms of Europe, Central Asia, so kind of this is a historical base for PPPs. So you've had privatizations or partial privatizations in many European countries. So you've got Frankfurt, Vienna, ADP, Heathrow, through BA, etc. The Portuguese sale. Asia Pacific, so you've got a combination here of concessions, equity share sales. So Japan, until recently, until a few years back, was publicly owned. They've gone down the privatization route or PPP route. The Chinese airports, a lot of investment going into China for new airports. On the PPP side, you've got Malaysia, the Philippines, India, which I talked about, Philippines, which tried kind of a more hybrid model. So they kind of mixed public EPC for the construction, and then they brought in the O&M for one of their airports. This was the Clark Airport in the Philippines. And then equity shares sell in Australia. And then Africa, Middle East. So as we've talked about, this is kind of more of a public model. There have been some PPP developments in part of Africa. Some trial with the management contracts in Egypt, in Saudi Arabia. There's also obviously the Medina airport, which Kashif mentioned, which I was very glad he talked about since we were involved developing that, as well as Queen Alia in Jordan, which was developed in 2007-08 as the first PPP in the Middle East. So in terms of, so I did say at the beginning of the presentation that we're not going to focus on acronyms, so bear with me. I'll try and only touch on it on this slide. But in terms of the spectrum of involvement from private sector, so you've got the green, yellow triangles, so all the way from EPC, where the government essentially does everything, through public tender packages, all the way to full privatization or partial privatization of the asset. Along that line, the responsibilities, the risks that get transferred to private sector increase significantly. I think importantly for each of these types of models that are mentioned here, you have many, many different variations. So when I say O&M to one person, it will mean something completely different. So an O&M, which we'll touch on later, can be tailor-made to suit the needs of the government in many different ways. In terms of what kind of models we've seen globally to date, so the concession model is the one that's kind of leading the pack in terms of numbers, followed by the trade sale and then O&M contract. So that has evolved, has changed over different years in terms of what the focus has been. But that's kind of a general state of play as of today when you look at it from globally. So some examples of BOTs type projects I talked about. Partial privatization. Example of Aéroport de Paris in France in 2005, which I was also involved in. There, the interest of the government was first of all to do a partial privatization, so it sold off 30% of ADP. So there was a financing angle. It wanted funding for the public coffers, as well as increase operational efficiencies. It's dropped down to just above 50% as of today, and it's looking to reduce its stake further, depending on the political situations. You have other models in terms of separate terminal ownership, so basically taking a terminal and giving it to the private sector. You have Dublin Airport, which is a good example. You have less good examples, which include Toronto T3 and Brussels, that were done in the 80s and 90s. So again, just to give you an example of Brussels, the issue there was the terminal was given to the private sector. You had a misalignment of stakeholders. So coming back to Kafra's point in terms of aligning stakeholders, you had the government operating the airfield with a structure of airport charges that encourage long-haul flights. And you had a terminal operator that was incentivizing regional flights. So obviously, in terms of traffic potential, that had an impact, and that project was not too successful. Again, on Toronto T3, issues of interface issues between the public entity and the private entity operating one terminal versus operating the rest of the airport. So in terms of transfer risks, so we mentioned the range from kind of pure technical assistance, a very specific type of contracts, to full sale of the asset. As you move towards the concession and the full sale model, you're transferring many of the risks and responsibilities over to private sector. I think key point here is you can transfer all the risks you want. So ultimately, the government is in the driving seat in terms of what risks it wants to transfer. Now the question is, which are the risks which are best borne by the private sector and which are best borne by the public sector? And any risk you transfer to the private sector will be priced by the private sector. It's not there's no free lunch. So for example, an easy one here would be things like pre-existing environmental contamination. You ask the private sector to come in and to take responsibility for any contamination on a land site that they were not involved in to date. They can do that, for sure, but they will pass on that cost back to the government. So that's a clear example where the responsibility should be kept by the government. Traffic risk or volume risk is a bit of a more difficult one. It depends on a case-by-case basis, which is why, as I said at the beginning, there's no one single template model. And for example, if you're developing an airport that has no track record of traffic or very low traffic, that has competing airports around it, some kind of guarantee or reassurance around the predictability of traffic is going to be mandatory. If you have a single capital airport with no competition, with exclusivity around the developments of future airports, then that's a different case. Me as a bidder, I'm much more able to predict future traffic and drive my investments. So just turning to kind of the beginning of a scale in terms of service contracts. So this is the baggage handling contract with Siemens Post at Dubai Airport. So this is a clear example of outsourcing a very specific service that's required at the airport. It can be a very short duration, very specific, very easy to implement, and you can do that across a range of services, activities at your airport. So that's essentially one model. You have the O&M model. So this is an example of Riyadh Airport T5. The thing about O&M contracts, and something that I like quite a bit, is their flexibility, versatility. So you can have a very light touch O&M, where you basically have a fee for service. The operator runs your terminal or certain parts of the terminal, and that's it. Or you can have a more advanced O&M where you build in some more heavy maintenance, perhaps some specific investment requirements later on. So it becomes closer to concession, but it's still an O&M model. I think the issue around O&M, and in some cases O&Ms have got bad press, and essentially that's, for me, has come down to drafting of the obligations. And if you make shortcuts, or you're not prepared from a government perspective in terms of how you're pushing these responsibilities to the private sector, you always have a risk of shortcuts being made by the private sector. So, if you have a very light touch O&M, and you have the private operator that dedicates, one person a month to come in and provide light touch consultancy services, I think the impact on your facilities will be much less than if you have a dedicated team on the ground that's training the local staff as well. And all this is by design, so you can integrate it into your contract. If you do things properly, you can make sure your O&M works to resolve what you're looking for. In terms of the concession model, which is probably the model that we work with the most because it fits the needs of our government clients in most cases, we have Queen Alia Airport and Medina Airport, both of which we prepared for our government clients. So one in both of similar type in terms of you're developing a new facility or facilities in ongoing operational airport, which does add some complexities. I think both were successful. I think Medina, which I spent 3 years of my life on, but I think they were 3 very worthwhile years because the result was fantastic. And I think key around Medina was kind of a fair allocation of responsibilities and also a great partnership between the Saudi government and GACA and the private operator. I think as part of any concession, we try and forecast and build in as much of the unintended consequences that we can think of, but you can't forecast everything. And I think because of that, you need a partnership to work around any wrinkles that you come across. And I think that partnership, in the case of Medina, has proved to be very successful. It's led to other actors kind of imitating similar models. So just a quick brief on Medina. So it was essentially the investor came in to design, build, finance, operate, maintain a new 8 million passenger facility, and then operate the entire airport, with GACA being there as a very strong partner on the regulatory and supervision side. On Queen Alia, so again, similar approach, the only difference being that the design architectural work was imposed on the concessionaire by the government. So coming back to Kafshaf's point in terms of costing, I would tend to agree that the costing maybe could have been optimized, but again, the government is in the driving seat in terms of deciding what it wants to do. In this particular case, it decided it had a specific design, architectural concept, and master plan it wanted to impose on the bidder, which in our view, it's better to leave it to the bidders to innovate and provide their own approach. Often leads to reduced costs, which again will make airlines happy. Also means the operational efficiencies can be minimized. If I am an operator and designing an airport that I'm going to be running for the next 5, 10, 15 years, I'm going to probably pay a lot more attention to how I prepare my design and make sure it's fit for purpose. So, you know, I think Queen Alia ultimately was a success story. It was developed. It would not have been developed otherwise. In terms of phasing, the traffic growth was actually higher than what was anticipated. So the phase 2 of the development actually started more or less immediately after the end of phase 1, which again is something that could have been avoided had the design been developed by the private sector. So partial, full privatization. So we have 2 examples. One which I know well, which was the ADP, 30% sale in 2005, which then increased to close to 50%. And then the Heathrow example through the privatization of BA in the 80s. I think just one point on that is this is a very specific type of PPP model. It's one that's only relevant for me in very mature markets where the airport is ready or where the government is able to extract the maximum value from the asset. If you're privatizing or selling off an asset which still has a lot of potential in it, which still has a lot of traffic growth in it, you're essentially leaving money on the table. So this model is something that does work in certain cases, but in many cases it's not relevant, especially in the markets that we operate in, which are emerging markets. And then moving from the pure terminal approach, this is LAX, Los Angeles Airport. So we have 2 projects. One is an automated people mover on the left, and one is a centralized car rental facility, both costing around $2 billion. So I think especially in the US, the move, where there's definitely a need for infrastructure investment, the move has been focusing on specific assets within the airport that require funding. These are both on, I think, 25, 28-year type concessions on availability payment type models, and were launched last year. So again, something that can be considered in certain examples where, you know, privatization or PPPs of the entire airport may not be relevant. And then other models, so moving away from the PPP model, so as everyone should guess, the example on the left, Dubai Airport, so government run. You've got the Newark, New Jersey airport on the right. So very different airports in terms of service standards, I would say. So that's also one option is, the government can do this in-house and run it from a public sector perspective. Just touching on the Newark example. So Newark now is going to be operated by Munich Airport with a JV with Carlyle, the PE group. And just to quote, the Port Authority management. So this is the entity that's responsible for operating, or was to operate Newark Airport. His recent announcement was the Port Authority is committed to moving our airports from back of a pack to best-in-class facility standards and to a level of global best practices that our passengers demand. So this is the executive director of the Port Authority running the airport. So I think there's a realization that from a service perspective standard, there's a lot of improvement possible. So here they're essentially tapping an operator to run a specific facility and invest in that facility at Newark. Corporatization. So here we have the Changi model, where essentially, again, you do it from a public sector perspective, and you develop an airport group that is so competent that it then is able to even go and invest in projects globally. I think corporatization, in some cases, can be a means to an end, or can be an interim phase. So on some projects we work on, the airport entities want to go through a corporatization process, but this is just an interim step until they do a PPP concession. So it's essentially getting your house in order, getting the books in order, getting a better management accounting system in place, getting a better grasp on what your revenues are before you actually go out to the market. Or it can be the end game, which is the case of Changi. I would say that in many markets we operate in, this model is not applicable because the government does not have the capacity to do it, or it will take them a very long time and a lot of investment to get to here. And the PPP route is probably the faster route to delivering on their objectives. Quickly touching on the not-for-profit. So Curtis is much more aware of this model. So this is Vancouver Airport. So essentially, all the profits are reinvested into the airports. The airport entity essentially pays a lease payment back to the government on a yearly basis. Again, an interesting concept. I think this Transport Canada, which is the entity responsible for regulating the sector, did indicate that there were some issues with the model. But again, it's one model amongst several. And there were complaints, I think, from the operators in terms of the size of the lease payments that had to be made. So quick snapshot in terms of, this is kind of a podium, a ranking of airports, public and private, in terms of quality of service from a Skytrax rankings perspective. So I think a message from here is you can reach a high level of service standard through both methods. Only word of warning is, the public tag which you attach can be understood in very different ways. So Munich Airport is a public entity. It's owned by public shareholders, but it's very much run in professional and corporatized fashion. So if you are able to develop your airport or airport group to that level, then that is a model that can work. These are recent quotes in terms of transactions in the market over the last year or two. I think, just reading through several of these quotes, I think had you gone back 10 years ago, many of these names would have been unheard of for most people in this room, or for everyone in some cases, because some of these did not even exist. So I think key message here is the ecosystem of airport investors and operators is changing rapidly. It has changed, I would say, over the last 10 years, but even more and more so. And you increasingly see, especially in more developed markets, the presence of institutional investors with a lot of capital available to deploy. And other actors also getting very comfortable with the airport model, the kind of stable revenue generation. And I think that trend is going to increase. You're going to see many of these actors that were traditionally more comfortable in safer, more developed markets, kind of moving to the more emerging markets because the return potential is higher. So what are the objectives? And the reason I'm finishing with this rather than starting is I want to really leave you with a message that I think you need to work backwards from what the government objectives are, rather than saying, you will do a BOT, you will do an O&M, because this was done elsewhere and this works. You need to understand and go through in a very granular fashion what the government's seeking and whether a particular model or an adaptation of a particular model works. So management, in terms of better management of large investment projects, in terms of improving your customer experience, in terms of improving your operational non-aeronautical revenue potential. From a financial perspective, developing new sources of funding, whether this is through bond financing or project financing, increasing revenues for your budget. So looking at Kashif, just on that point, I think the idea is, airports should not be price gouging airlines or customers, but at the end of the day, the opposite model does not work either. So in many cases, in emerging markets, you have the government that's essentially subsidizing airline passengers out of the general public budget. And that, in my mind, is not fair either. So I think you need to find a balanced way and have a pricing that's adapted. And also having a pricing that's adapted will ensure that traffic grows properly. Wider financial sustainability. So again, it's not just about one airport. You may be looking at your airport ecosystem and saying, I'm going to develop my capital city airport, but I have these more public service obligation airports that may only have 50, 100,000 passengers in remote parts of the country. How do I structure these transactions to make sure we can funnel money across the sector or share the revenue generating potential fairly? And then macro, so again, classic best practice in terms of separation of regulation and operational and security aspects, improving the sector efficiency, improving competitiveness. So just to finish on this, so not one single model, and reinventing a wheel can be a good thing. So a wheel and not the wheel, because there's not one single PPP model. Within O&Ms or concessions or privatizations, you have many different types of variations on it, and having a template approach to your transaction is quite a dangerous approach. Start with the ultimate objective. What do you need as a government, and how can you add value, and does the PPP add value in your case? Think of new and untested models. So, the O&M, the BTO, the DBFO models, some of these models did not exist 20, 30 years ago. They've not been in our vocabulary forever. So I think new models need to be thought of. I think I touched on this kind of clustering in terms of how you deal with the smaller airports, doing packaging, maybe having a variation of models within the same transaction, so having more in-depth or more firm commitments on investment for your larger airports, and then lighter touch O&M type approaches on your smaller airports. I think we need to think slightly outside the box in terms of how we develop our airport transactions. And then think small before thinking big. So always, if possible, try out on a pilot project, learn from your mistakes. Mistakes are inevitable. I think thinking that you're going to get everything right from day one, even if you copy the best model that was done elsewhere, you may have local issues that will mean that you will have issues. So learning from what you're doing and then phasing your development over time and not doing things in a big bang approach is another learning. And then finally, again, no shortcut to preparation. You really need to focus on preparing your transactions. Whether it takes a year and a half to prepare a transaction, it's really time and money well spent. It avoids issues later on. Framework, you need a strong framework, legal, regulatory, either at the sector level, or you need to make sure those gaps are plugged through your contractual documentation. Selecting the right player, again, the importance of doing a proper pre-qualification phase, making sure you have the right players who are going to be your partner over long term. Selecting the model we've talked about, and then capacity. So again, the role of the government does not go away once you've done your PPP. You need to make sure you have that capacity internally, and if you don't, you need to identify that very early on and make sure you fill that gap. So I'll stop there, and I think we'll move to questions. Thank you.
Thank you so much, Mr. Alex. And now the floor is open for your participations. Yes, we have.
regarding the stimulation of private investment in Africa. So the growth now is, or the concessions are around 11%, but we can only do it when there is a political support. But how can we stimulate the investors, concessionaires, to do more investment in this sector, especially that there is a huge upfront capex for business case development? IFC have been leading some of them, like Medina Airport, as you said, and Queen Ali and others, but how can you stimulate more of the private investors, major operators, to support this market and grow the private sector participation potential?
So that's an excellent question, and it's one issue that I've been struggling with for many years now, and it's very saddening for me that we haven't been able to do more in Africa. I think Kashif mentioned some of the issues. I think ultimately it may sound obvious, but there's a lack of project pipeline. There's a lack of project preparation, and if there's no projects, they're not going to be investors. That's kind of obvious. Why are there no projects or limited number of projects? I think alignment of stakeholders is often an issue. So airlines, airports working together and understanding what solution is needed. I think also in some cases, sources of funding have driven the choices of governments. There have been very low-cost funding options for many African countries, and they prefer to go down a public tender route using these cheaper sources of financing. I think there are several cases where ultimately the cost was a lot higher than they expected. Facilities were designed which were overbuilt. So in terms of optimal outcome, I don't think they always reached what they were aiming for. And obviously this financing often turns into debt as well. So it's not a free lunch either. So I think it's also an issue of understanding capacity and knowledge. And again, this is an issue that's faced in many of the countries we work in. It's not unique to Africa, but I think there's been more of a struggle to get that message across that the private sector can actually help you. The private sector is not here to take away your cash cow. And this is an expression I've heard in many cases in meetings with counterparts in parts of Africa is, this is our cash cow and we don't want to give it up. When that cash cow, if it is a cash cow, which is debatable in some cases, could actually become a much bigger cash cow, and some of that revenue could be shared with the private sector. Yes, they need to make returns on their investment, but ultimately it will be for the benefit of the government, and they'll get more revenues as well. So I think it's a mix. There's no one single response on that, but I think there's a huge need for projects to be developed in the country. And I think we're continuing to focus on trying to push this through. So hopefully keep your eyes open, and you may see some coming through the pipeline in the next year or so.
And maybe just to add on that, the pipeline also has the challenge of a political cycle. So if it takes a year or a year and a half to prepare the transaction for market and another 6 to 9 months to run the process, you often run out of political bandwidth because an election gets in the middle of the process or another political factor, and we've seen that in many places, or the situation changed. Like in Beirut, things are slowed down now because of what's happening there. In St. Louis, long way down the road, and then suddenly the 20th of December, the mayor announces the project is dead. So getting to a successful transaction has many hurdles, and you often have to fit within a political cycle, which is challenging.
Hi, good morning. Here's Moash Mai from ACOM. My question to the panel is, I heard that it's dangerous to have a template for a PPP, but as a concept, it is better for investor and to know that it is a standard to save time and money during the negotiation. So is it dangerous to have a template for PPP, or it is better for the investor?
So for me, and perhaps other people will disagree with me, an airport is not like a solar plant. So we do a lot of solar projects as well, and we have a model that's called scaling solar, where you basically have the same template document, same contract, Same terms and conditions are accepted in each country every time you do a project. So that allows you to do projects much faster and cheaper, as you mentioned. I mean, the problem with airports is they're much more complex assets to deal with than a solar plant, both from an infrastructure point of view, from a stakeholder point of view, from an investment planning point of view. So I think you can go halfway in terms of template. You can say these are the basic concession clauses that you need in a contract in terms of like termination clauses. So basic bankability aspects need to be covered in your contract. However, you can't take a contract from country X and say, we're going to apply it to country Y, or you can, but then you're going to end up just negotiating it to death between the lawyers and the lenders because the contract will not make sense. So that's just from a legal perspective. And then from a technical perspective, obviously there's no template because the technical requirements for each project are going to be very different. So yes, abide by the same guidelines or the best-in-class approaches or clauses, as I mentioned, but you can't have a template in my mind.
And I think there's also sensitivities in certain projects. For example, I can think of one in the Caribbean. The word privatization was a toxic word. And so we're talking about a privatization of this airport at a conference. And back home, that translated into giving away your prime asset. So every one of these countries has a different sensitivity, and so you can't have a sample or a template that fits all the conditions. And it's really understanding how you manage both the framework and the language. And again, back to this political issue, that project failed due to a change in government, and it was shelved, and it got caught up in a lot of debate. So there's not an easy way from A to B, but having a government that's highly committed, and we were talking a lot about Queen Alia, it took a lot to get Queen Alia to the transaction, but that first 18 months of that transaction were fraught with a lot of problems. There was a redesign, a $50 million addition in capital during the 2008 economic crisis. And so the only reason that that project is still operating and is successful is the government was absolutely committed and didn't bail out. They didn't second guess their commitment, and they knew that this was the only way the project was going to be done. But getting a very strong and committed government to stay with the project irrespective of the difficulties, I think that is where the success and failure lies.
Thank you, gentlemen, for the presentations. I kind of like asking about when it comes to investors, always when you do the investment upfront or what have you, we have not seen the exit strategy, what it looks like. I know airport asset is complex, it's always long-term things, but in Trouble Bs, what might be the exit strategy if things goes wrong? Would you please, any one of you, shed light on exit strategy in terms of things goes wrong?
Well, I can think of a recent example in Istanbul that the investors in that project were primarily contractors, and they had barely opened the terminal, and they were talking about exit. And the government stopped that conversation very quickly to say, and that's to my comment earlier, that if you have primarily contractors in your consortium, they have to stay there for the long haul to be committed to the ultimate product, not just build it and run. And so they stayed, but there are other examples where projects have gone sideways, and I can think of one in Africa where they had a difficulty with an investor, a European investor that was primarily a contractor. There was a falling out with the government, and luckily for the government, they found a new investor, but somebody that we might have not expected to be interested in investing in that airport, and I'm thinking of Qatar Airways. They basically invested in a troubled project, but now they have a tremendous control over what happens in that country with the investment. So there are opportunists that are walking in and capitalizing on opportunities, but I'm not sure the government had a choice. They had a very troubled concession to begin with because it was primarily driven by a contractor trying to get their profit out at the front end and leaving. So to my point earlier, when you're structuring a concession, be very, very confident in the structure of your consortium, that it's not overly weighted to a contractor, an operator, or somebody that may not have the long-term interest of the concession in mind. And operators typically do because they're there for the long haul, but short-term investors, you always have to be careful. They're going to cut and run when they get their profit.
Just to add to that, I think, again, this is something you as a government will decide from day one. And you set the rules of the game in the contract. So you would say, coming back to the operator, you know, if you're looking at a concession type model, you probably have an operator, you have financial investors, you may or may not have a contractor inside the consortium. It depends on the approach by the consortium. Definitely the operator, you want them to be there for long haul. So you're fixed in the contract, but you can't leave before, let's say, 5 years after the development of a new terminal. So they're forced to live with any mistakes they may. Financial investors, you may have a different exit strategy. You could phase it out, so you could have a drop down in ownership on year 5, drop down in year 8, year 10. All these you define. Contractor, again, I agree. The contractor should not be the one driving the project, because then, you know, the alignment of interests is not there. And again, many consortiums will not want the contractor in the consortium because they want to wait till they win the bid to then negotiate their construction contract with many different players. So often that you may not have a construction company in the contract. But again, it's something you need to think of carefully, because once the bid is done, you know, it's too late. So you really need to do your homework, understand what is in your interest, but also what the market will accept. So if you put in your contract, you must stay for 30 years, you may get a pushback from bidders, or you only get one bidder. So again, you need to see what's realistic and what works for you.
Yeah.
And just to reiterate on that, it is important to get that balance right. You do want a fluid situation where investors can come in and out over a 30-year period, but you have to set the right conditions for it.
Yeah, just to add a comment on what you said, both of you, is that on the concession agreement, it's very important that the exit strategy is clearly stated to everybody, so the rules of the game are clear. And second is, it's very important to have a balanced consortium between airport operators, contractors, and financial investors. You don't want anybody to be stronger than the other, and this is key. And once you have this balance in, I think the exit strategy would be different than if you have one contractor or anybody else which is stronger than the other.
One last question from my end. Talking about financial investors, we totally understand that international financial investors would price their equity at a higher rate than the local or regional financial investors. Are you seeing a pickup in interest from regional financial investors to invest in the airport space? And what would you do as someone involved in this space to attract those financial investors to make the bids more competitive and cheaper for the governments, basically?
So I think in some of the examples we've talked about, so Medina, one example, you had local investors involved. So there are local investors. I think it depends on the size of a transaction. If you're doing a multi-billion-dollar transaction, you may need external sources of funding as well. And you may need a mix. You may need these international investors to come in to provide comfort to regional investors as well. So I think as long as a project is structured properly, but people have a time to do their homework, you can attract your local or regional investors. I think many of these projects are new in some of the countries in this region, but also in other countries you operate in. So there's also a learning experience. So let's take the example of on the lending side, so not on the equity, but on the debt side, kind of project financing on airports was a novelty, for example, in Saudi Arabia. So taking volume risk in a country where traditionally they were used to the IWPP model, which is very different in terms of risk allocation, was a novelty for many of the local banks. So getting them to understand what volume risk means, what project financing structures look like, was again a journey which took a bit of time, but that comes to a point where I think as part of your project preparation, your tendering phase, you need to make sure you give enough time, especially if you're developing a novel concept, to whether it's your investors or your lenders to get comfortable with the transaction and to provide their feedback and for you to adapt their feedback into your transaction.
And I think the other trend you're seeing over the last 4 or 5 years is more and more pension funds are getting involved, and we're getting a cheaper cost of money coming into the market, it's getting a little bit more crowded. And even in the case of PSP, they bought an operator, effectively. But this is the big irony in Canada. We have these great pension funds sitting there ready to invest in airports, and they're doing it all over the world, but they can't do it at home. And just to touch on that aspect, you talked about mature assets that have low risk and not tremendous amounts of growth ahead of them. As a Canadian taxpayer, I want to see those airports being bought up by the private sector and operated for a lower cost of capital and freeing up the government's money to build hospitals and schools and things that the private sector won't build in Canada. So it's a tremendously frustrating thing for me to see that chart that was up earlier with 1% of airports in North America being private sector involved, because we've got this tied up capital that is better spent by governments elsewhere. It's about recycling capital and putting it where it's needed. And we as a group have to be able to tell a better story about that, not just in North America, but around the world, that there's scarce capital within governments, and let's activate it. People are sitting on a lot of capital right now, and it could be activated into airports with good returns for government and for private sector.